Welcome to this Friday webinar, everyone. Today we have Suraj Nanda from ICICI Prudential team to present dynamic equity strategies for enhanced asset allocation by ICICI Prudential. We have seen equity markets have been quite volatile, especially after the earnings for Q1 and Q2 came out as dismal. Markets have actually been kind of not, I would say, very steady from here onwards after having seen stellar bull run over last couple of years. And as valuations are struggling, as valuations are high and markets are struggling, it is important to kind of also understand the significance of some of these dynamic equity strategies, which are trying to blend smart investors' portfolio on, I would say, superior risk-adjusted returns. We have heard a lot about long-short funds, and there are very few long-short funds in the industry which actually do good work. We know a lot about them, but this is one, I would say, superior form of a long-short fund which dynamically tries to balance risk and return. We will understand more about this particular fund and the strategy in more of a educative manner by way of this presentation, which has been created by Suraj Nanda, who brings with him more than 8 years of pertinent experience, having worked with ICICI AMC. He is an engineer by background and has done MBA in finance, and then he has been kind of working with ICICI for last 8 years. Over to you, Suraj. You can introduce yourself and introduce the context and genesis of this fund. And then I am curiously going to look for the presentation. We'll take Q&A from our clients subsequently once the presentation is over. Over to you.
Yeah, hi Kamal and hi everyone. So as you know, Kamal, so basically an introduction about me. So I have been associated with ICICI Prudential for the last 8 years, and I started as an analyst and started covering sectors like capital goods, chemicals, building materials, and then started managing few thematic funds on the PMS side, and then I've started managing a fund on the AIF long short side for the last 2-3 years. So as you know, Kamal gave a very good introduction about the presentation which I am going to give, given that the markets have given a very good return over the last 3 years. The Nifty has given almost 13% CAGR over the last 3 years. The mid cap and small caps have given almost 24 to 25% CAGR over the last 3 years. So the investors have made a very good return over the last 3-4 years, and at a time when we are seeing a lot of geopolitical tensions, be it on the Israel Middle East side, or be it on the Russia Ukraine side, and these things which we hear about US China tariffs. So a lot of uncertainties which are there, and given there were elections globally in 2024, you had it in US, you had it in India, and there's a slowdown which we are seeing in India. So a lot of uncertainties which are there, and the valuations and the growth which is built in the stocks. One has to be very careful in terms of having what kind of equity allocation one should have in the portfolio, right? So this is what we are going to present, given that there's a risk and return conundrum, because a COVID kind of a scenario, you can increase the equity allocation because the markets corrected significantly, and you can increase your equity allocation, given that we have reached a stage where the markets have done very well over the last 3-4 years. The risk part of the conundrum has increased very significantly, given the reasons which I gave. Now, as I said, let's talk more about the risk part. This graph gives us a very good, understanding, given that, we know bonds have the lowest risk, followed by the hybrid funds, which we have, followed by equity and venture capital. Venture capital, we know, is the highest risk, given that, 1 out of your 20 investments will give you a, multi-bagger return and give you a good, absolute return. So, the amount of risk which you take, it's directly, proportional to the return which you make, right? But it also depends at what stage of the cycle you are taking the risk, right? So if you're taking the risk at at the highest of the market valuation cycle, the probability of making a higher return also reduces at that point of the cycle. However, as I said, if you're taking a higher risk during a COVID kind of a fall, post that fall, it increases the probability of the higher return made on the investments. Now we talk about now the question which we get, we should look over the long term, right? Because markets do give a decent return over the long term, almost a 12-13% return, but this return which we see, it's never a straight line. As I said, there are periods like nobody anticipated that there will be a COVID, right? But we saw that, and we saw the kind of fall which happened, right? So there are a lot of uncertainties which come in the way of getting to that 12 to 13% CAGR. Now this is what we are showing. Yeah, there will be periods where markets will fall due to some wars, some COVID kind of a scenario, something or happening on the economy front, on the government front. So that leads to fall in the markets. So basically, what we want to say is, we live in a VUCA world, which we have, learned in different textbooks. Now, what is a VUCA world, right? There is a volatility, there is an uncertainty, there is a complexity, and there is an ambiguity which is there, right? Now, volatility can be due to, different things, right? There could be some geopolitical tensions which are there, or the US data, if it comes bad, good or bad, or the Indian data which comes good or bad, that leads to volatility in the market. Then there are uncertainties in the form that some trade wars happening, some anti-dumping duties put, some tariffs put, some change in political scenario which we saw post elections, due to which markets reacted significantly. Now then there is a complexity which we are seeing across industries, right? Due to the onset of artificial intelligence, we don't know how each industry will get impacted, whether how much efficiency will it bring into the system, whether it will lead to job loss, what kind of skill development has to happen. So these kind of complexities are also there across industries. And then there is an ambiguity also which comes in the form that you don't know what, for example, Trump will do after coming into power. What kind of tariffs will he put? Will he put that kind of tariffs on China, or how will it impact India? How much tariffs will he put? So those kind of things can lead to a lot of volatility in the markets. No, so that is why what we try to do, how to navigate in this world where the valuations have are a bit on the higher side, and the uncertainties globally are also there, right? So that is where we talk about more a dynamic equity allocation through hybrid funds, which helps you in managing the equity allocation in your portfolio across different market cycles. Right, so that will include hedging the portfolio, or diversification into a more of an bond space, or alternate space. So that helps in managing the risk of the portfolio very well, and enhancing the risk adjusted returns. So what are the limitations which we see on the static allocation strategies? Generally, what we see on the long only fund side, they are it becomes difficult for them to adapt to rapid changes in anything, right? Whether it is a change in tariffs, or something related to, as I said, artificial intelligence, or some change in government. So it becomes very difficult to adapt to those kind of changes. And there is an overexposure also to equity levels only, because we are almost at in a long only fund, we are operating at 90 to 100% equity level. So we are almost completely exposed to one asset classes, and that leads to the reduced returns which we see during crisis, because we are not dynamically managing our equity allocation. Now, this is what we have seen. When you include, alternative investments with the traditional investments, you see a much better, risk-adjusted returns. Given that, the risk part is managed through, the derivatives part, and that also helps in generating that additional, returns which we see. Now, the alternates, when we talk about how is the, old world portfolio allocation, which we have read, in the textbooks, right? 60% equity, 40%, fixed income. Now, the new world, portfolio allocation does have, 20% alternatives, which, have your, where you can use, different, instruments on the stock derivatives as well as index derivatives to manage your risk and the volatility of the fund much better. So this is just a pictorial representation of how that at a different risk level, how you can move the fund from, for example, a 60-40 equity debt portfolio can be moved to a 50 equity and 30 debt and 20 alternates. And as per few of the reports the published by JP Morgan, which we have seen, that it leads to a much better Sharpe ratio of the fund. If you see the data which we see, the volatility of the funds also reduces, and it helps in generating that additional return, leading to a much better Sharpe ratio. And this has been, published data based on, from first quarter from 1990 to 2023. If you see, you can they have this data where if you include these alternates, you are able to get a much better risk adjusted returns. Now, the slide, this slide, we have seen, dynamic allocation funds on the mutual fund side. What differentiates, enhanced dynamic allocation on the AIF side is because you have a much higher exposure levels, right? A dynamic allocation normal fund, you have only 100% exposure, and enhanced dynamic on the, AIF side, you have almost a 200% gross exposure, which allows you to take leverage and manage the risk much better. So basically what we have seen is that the risk levels are almost similar to a dynamic allocation fund on the mutual fund side, but you are able to generate that higher return because of the higher exposure levels, as well as the additional flexibility which is there in terms of using the derivatives to generate that additional return. So when you look at it, when you see that if you want to generate that return of 17 point, so we have done this, analysis where, if you just have that equity, the normal standard investment, the standard deviation of the fund, to get to that 17.7% return over the 5-year period from 2009 to 13 is almost 33%. But if you are able to, dynamically manage the fund through equity allocation and everything, then you are able to generate that similar return with a much lower risk. So that is what the objective of the fund is, what the strategy is. So what are the objectives here is, we have seen a very good rising market. We have not seen a falling market. We just saw 1-2 months, and then there is a sideways market. So the objective is to generate to capture as much as the returns of the rising market, and then after then in a falling market, your aim is to limit the downside, and the sideways market helps you to generate that absolute return, given that you have those derivatives exposure to earn that premium income and everything, to get to that return, additional return over a normal dynamic asset allocation fund. No, this is how you manage the equity exposure in a dynamic fund. So you have a long only portfolio which is there, and the remaining the derivatives part is used to move the net long of the fund from almost 0 to 140% here, because 140%, because you are able to take leverage and use that exposure of 200% to move to take advantage of both the upside as well as the downside. So for example, in a COVID kind of a scenario, or any big fall which we see, you can take the net long to more than 100% also, which a normal long only fund which we see cannot do that, right? And in a scenario where where the valuations have run up very high and the risk you see in the market is way too high, you can even go to almost a 10 to 20% equity allocation level. Now, when we talk about alternate strategies, right, or use of alternates, right, so that includes a lot of, derivatives, which we use, to hedge the portfolio, the cash only part of the portfolio that is used for, you can use the stock futures to hedge that portfolio, or stock options to do the covered call writings. Then, you can also do what we have seen, global hedge funds do in terms of taking long and short positions based on fundamentals. So that part of the strategy can be done, and to generate that additional return what we see on a pure long short fund, that part you can do. You can do arbitrage, what we have seen arbitrage funds on the mutual fund side, what they do to generate that arbitrage return. And also, as I said, the managing of the volatility using the index derivatives part, where you move the net long from 0 10% to more than 100%. So the index derivatives help to capture that part of the strategy very well. Now the framework, one can say, when to go overweight on equities and when to go, underweight on equities. So that is based on a valuation model which we have in house. So basically, that model, we take into account the valuations, the PE, PB, the market cap to GDP, and bond yields, multiple factors, and those have been time tested over last 10-15 years, given the dynamic funds which we have. So, and on basis of that, you get a figure where you can understand how overvalued the market is or how undervalued the market is, and based on that you can take those calls on how much you want to run aggressively or conservatively your fund. So in terms of we have the team which we have almost a very good analyst team, given that I have also come up from that analyst team, and we cover almost 600 companies and almost able to cover every sector, and the coverage across mid cap and small cap ideas, and that helps us to stay in touch with all the emerging trends which are there in different sectors, and also be up to date across sectors and companies. So just a brief about how the team is. So we have almost a team of over 20 analysts, and covering almost the entire universe of what we have across the 20 sectors. So this process is very similar, right? You do that initial screening of company, do the research along with the analyst. You have an analyst model which is there, which gets captured in the model portfolio, the alpha system, and you get to know where they are positive, and what kind of risks which are there. And on the basis of that, you are able to do the meetings, the channel checks, and everything, and to get to that how much positions have to be built across stock, because the discussion on the sector and the stocks also happens at a very detailed level to build that kind of a position across stocks and sectors. So yeah, this is what I wanted to present on the dynamic strategies which we have, and I will give it to Kamal now.
Sure, Suraj, you can maybe stop the screen share then.
Yeah.
Let's maybe take a few questions. Perfect, Suraj. So this is like, an interesting and superior long short fund. But, I'll tell you the experience of most investors with many long short funds has been like, a lot of expectations, but results are like dismal. I'll tell you why. Because at the end of the day, people give money to equities and asset class to make, eventually long-term returns, at least in double digits. But when it comes to investing in some of these enhanced equity funds, and when market actually goes through a bad phase or a change in cycle, they are not able to actually cope up. Most of these funds have seen kind of ultimately returns in either single digits net of taxes in the hands of investors. And over time, investors realize and learn that when they remain investors for longer term, even if they compare to Nifty 50 as a benchmark, they have underperformed. Now, obviously, a product which is a simple product in mutual funds, which is like a balanced advantage fund, is something which investors find as relatively more interesting because that still doesn't have high taxation and is more open ended. But obviously, alternate product, as you mentioned, is superior in nature and manages risk better and ultimately delivers returns also in a superior way. And that is the question which I think one of the investors are asked, that based on your inputs, would you say, in your view, ICICI Enhanced Dynamic Equity Fund is safer than ICICI BAF? So the risk factor, if it is considered, and compared with your own, I would say, balanced advantage fund, how would you react to that?
Yeah, see, the thing is that, as I said, the input for both the funds are similar, right? As I said, we have a in-house model which gives us an input, right? So the input is very similar. Whatever long you operate at is based on individual fund manager discretion, based on the input which is there. The given that you have a much better flexibility in terms of operating with that input, right? So when the model is giving you an input of 30, right, you can go below 30 also if you think that there's a more risk in the market, or you can go to 10 levels also. Similarly, when the model is giving you a output of almost 70 80 levels net long, you can even go to more than 100 levels. So these are the kind of flexibility which the fund gives us on the alternate space, which allows you to earn that additional return, right? So that is the advantage of the fund, because you are having a gross exposure of 200%, right? Versus 100% on a mutual fund side. So there are flexibilities which are there on the alternate space, AIF space, which helps you generate that additional return. It's not that we are safer or they are safer. It is just the flexibility which is there.
No, understood. Over longer term, if long-term horizon is given to both the funds, obviously, given the more conduciveness of your fund, given flexibilities, has a higher potential to manage risk better and deliver higher returns.
Yeah.
Absolutely.
Yes.
Well said. We understand that. Now, moving on to the subsequent, question, I'll tell you the space is quite attractive because there is very less competition. There are very few funds which are actually delivering what is being claimed. And hence I said, this is something which is absolutely, I'm also curiously wanting to understand this space, because I understand that yes, there could be a time over next couple of years, as you mentioned in the beginning, that markets are range bound or markets underperform because we have seen seller bull run and valuations are high. And obviously in that kind of a scenario, any one good long short fund which is actually able to kind of deliver what is being claimed will be the one which will outshine. And from that point of view, if your fund is positioned like that in comparison to other long short funds, it is something which is very, very, I would say, interesting, and we should definitely understand that aspect. So hence, from that point of view, I want to understand what is the differentiated positioning of your fund, from investors' point of view at these levels. If investor seriously wants to give you money to, add in his portfolio, what is the differentiated positioning amongst the entire landscape of long short funds?
Yeah, so see, the objective is to enhance the risk adjusted return, right? We understand the risks which are there. It is just that, we have to make it very clear to the investor that the risks currently in the market are high. So, based on that, the positioning of the fund is such that, at the current valuation levels, the equity allocation in your personal portfolio or in the where you are investing has to be much, much lower, so that you are able to protect the downside, your downside of the portfolio much, much better. And then once the market falls, you can capture the upside also, because in these kind of funds you can even capture more than 100%. So that is what the objective is, that over the cycle it can't be that you have a view that in 1 year the funds on the AIF long short side will be able to give you returns, right? It has to be over the cycle, that you have to have a 3 to 5 year cycle where you will see a market fall also, and you will see a market rise also. So that will help you to understand how the fund is able to capture both the downside as well as capture less of the downside obviously, and capture more of the upside much better. So that is where you have to look at it. Cannot be looked at from a very small frame, because for example, if the valuation levels or the models which tell us you have to be cautious, and as a result you run a very conservative net long currently, but the market goes up 8 to 10%. So it should not be that you say that you have underperformed the market, right? Because 1 year is too small a time frame for that view to play out. So you have to have at least a 3 to 5 year for the fund to give you that much better experience in terms of risk adjusted returns.
Sure. So that is where the problem is. 3 to 5 year is a very long period, which we generally ask investors to have in mind for proper equity investment. So if it is a 3 to 5 year period, then the fund ought to deliver outperformance over at least Nifty 50. And and yeah, if that is the objective, then if that is the objective, which means the beta of the fund is closer to the index. I'm asking you because investors need to understand, what is the, I would say, positioning of the fund. I'm again asking, in a very simple way, if I have a portfolio which has an asset allocation of say 60% in equity, 40% in debt, right? At this level, I am kind of confused. I do not want to put more money into equity, but yes, I am considering adding an alternate asset class in my portfolio, which is your fund. Right? What should I expect out of that asset class over next 1 year, 2 year, 3 year, in terms of returns, as well as in terms of volatility, as well as in terms of I would say any downside? Because I understand over next 3 years, maybe near term, world could see a world war, as you mentioned, geopolitical scenario, right? Market could fall. If market falls 20%, what will happen to your fund? If markets were to rise 20%, what will happen to your fund over next say 3 years, if not in short?
So that is where the model comes into the picture. You have to understand that in a bull market, if you don't use your own judgment every time, because you will be always bullish being in the bull market for the last 3-4 years, right? That is where the model guides us, and the valuation parameters guide us to where the how to position the fund. Generally the surprises come at the peak, right? So when that comes, you should be ready. It cannot be that you reduce your equity exposure only after the event has occurred. You won't be able to save your equity that level. So you have to be ready with that, and over a period of time you will see that you will be able to beat the market, because you have you capture the objective is to capture much less of the downside, because see, we are operating at, for example, 20 to 30% levels, right? And if the market falls, like the October month, it was very good, right? You only captured 20% of the fall, right? And on the upside, you have to capture when the market falls, you have to increase the net long of the portfolio to capture the much higher of the upside. So over the cycle, you will see you will be able to beat the Nifty 50. That is what we have seen, even in if you see the dynamic asset allocation funds which are there on the mutual fund side, because that is the data set which is there. You have to see over the long term how the dynamic asset allocation funds have done on the 5-year period or a 10-year period, whether they have beaten Nifty.
Sure. So let's talk
And
about
this fund, with the flexibility which is there, you will be able to generate a much higher return over that. That is the objective.
No, understood. Quite clear. Let's talk about your model behind the fund, which is the, I would say, engineering behind the fund, which guides you in terms of, I would say, dwindling your equity allocation from 0 to 140%, as you mentioned. And you also, mentioned currently it is around 25%. So what are those signals which are making you keep 25% at the moment? And what signals does that overall, model look for? And at what level will it be, say, 80%, 100%, or maybe 140%?
See, as I said, there are multiple inputs to the fund, right? There are valuation inputs like what we see PE, what we see price to book. Then there is a market cap to GDP, which the Buffett indicator, which is there. Then there is a bond yield factor, which is there. So there are multiple factors, and the model has been time tested over the last 10-15 years, given the dynamic asset allocation funds which are there on the mutual fund side, on our side, right? So it has been tested over that period to understand what works, what doesn't work, right? And that has helped us in guiding across funds how to position ourselves, whether to be aggressive, whether to be conservative, how to guide the investor, what expectations one should set to the investor at current market conditions. So that has helped us significantly in in setting the expectations right.
Sure, Suraj. So you mentioned that you started your career with ICICI Prudential as an analyst.
Yeah.
And may I please understand, what did you do over those 8 years as an analyst? What was your area of specialization?
So, I started with covering, capital goods sector. So that part I have covered. Then I have covered the chemical sector. I have covered the building materials sector. So, ICICI Prudential, gives you an advantage where, you are able to learn, multiple sectors over the period of time, to develop your, capability across sectors. And that helps you in your gradual transition also going forward to a fund manager, where you are able to understand the nuances of different sectors and able to take a call.
Sure. So now, what is your personal conviction about equity markets at the moment in, current, given your, I would say analyst lens.
Yeah.
I want to understand, how do you see, do you think at these levels, if you have to put your own money, you will sit on cash, you will put it in debt, you will put in long short fund like yours, or you will, maybe put into long only equities?
See, I will most probably put it into hybrid funds currently, given that, see, given the sectors which I have covered, I see, the valuation levels, of the stocks and the cap good side, you must be seeing, going through the roof, right? And we have to see how, the government, we have seen H1, right? The fiscal capex was, way lower, almost 18 to 20% decline. So we have to see, whatever was there in the budget, whether they are able to, meet that target, whether, the government spending comes back. But nothing, is there on the valuations. There is no impact on the valuations on that. So valuations are close to full, right? We are seeing a consumption slowdown on FMCG, right? Is it due to market share loss or is it due to demand issues? We don't know, but there is an issue. Right, so there is across sectors some slowdown which we are seeing, right? So from that perspective, and we don't know how the tariffs will impact, which industry will it impact, where will they put tariffs, how will the supply situation globally pan out with tariffs on China, right? So how the supply side chain will move with tariff, how much will go to US, or what will be the kind of rerouting of supply chain which will happen. So there are multiple things, right? And we don't see any kind of uh, discount on the valuation side from that perspective, right? The valuations are almost close to the full, unless there is a good demand uh, from the end consumer, or private capex happening, or government capex coming back. Then I think that it can support the valuations. Otherwise, if there are if those does the things, the demand doesn't come back, it would be a very, very difficult scenario. So you have to be much more on the hybrid conservative side, rather than going full long on equity, or even going being very negative and going to debt. Because I don't think from a macro part, we don't have any significant risks currently.
Oh, sure, sure. I'm only trying to understand, is it because you are long short fund manager, that makes you relatively more negative on market or
No, no.
cautious on market, or this is like, as a analyst, you are like with your mathematics, you are like finding it that it is a time to be cautious. That's what I wanted to know. But you're right in saying that obviously, one cannot know anything because markets have a lot of factors. But
Yeah.
at the same time, I know I can tell you one thing that while I agree with you mostly that yes, a hybrid fund has space in investors' portfolio, But investors, if you see the chat also, are not able to understand that what is the exact positioning. Though I understand that as an alternate asset class, but if you can maybe simply and try and explain it to the investors once again, that what is the positioning in any HNI portfolio. Because if investors today are putting money in fixed income, and fixed income gives them safety of capital, and they know that it is absolutely safe, but I am compromising my returns, I will make maybe 6%. If I'm putting money in equity, I know I could fall, I could come down, but if I have a 3-5 year horizon, I will put in equity, because in over 3 to 5 year equity market will certainly give returns more than fixed income. But why should I put money in long short fund? What is that objective in between these two, I would say, areas, and what will I get out of that? So if you put yourself in investor's shoe, you are ultimately going to manage this fund. I'm sure this is a practical question. You ask yourself this question, and if you can then answer it, that will really kind of
see, as I explained, in my presentation also, how the positioning of the fund is. The positioning of the fund is more on the aggressive hybrid part, right? What I am trying to focus is on the risk. What the question you are asking is more on the return, right? So when you are looking at the risk part, right? So obviously equity will give you a higher return over the 5 years, and debt will have the lower return, commensurate the risk, right? So what we are trying to do is, we are trying to give a aggressive hybrid kind of a product on the alternate side, which will help you, navigate that, market much better, and able to generate that additional return over the period of time, right? Over a period of time, see, it's easy to say that over 5 years, equity will give this much return. But what I'm saying is that we don't know what will happen within that 5 years, right? How the risk part is there within that 5 years. So the positioning is that it is a more of a aggressive hybrid product, to diversify your portfolio and to manage the risk.
Brilliant.
Not a complete equity, not a complete debt, aggressive hybrid.
Brilliant. We explained it now absolutely, I would say, pertinently. So for the audience, this is a fund from where you can expect lower downside, as well as, I would say, upside similar or maybe higher than the benchmark over a longer period of time. That's the endeavor of the fund. And obviously you are trying to do that by dynamically aligning allocation to equities, primarily from the point of view of valuations. And at present,
Yes.
because you're not too much comfortable about the valuations, the allocation to equities is only around 25%.
Yeah.
Right. So now moving on to the, I would say, equity construct of your portfolio, whereby you will have some longs and some shorts. How will you ultimately create the portfolio? Because it could be, I would say, a scenario whereby the kind of longs that you have had or shorts you've had, market actually behaves opposite. Because I can tell you what happened a couple of a couple of months ago, where market has changed its cycle. Till now, I would say some of the undervalued sectors were performing, be it, I would say, infrastructure, real estate, or logistics, some of these sectors which had not participated in the earlier bull run. And some of the quality sectors were not, performing. But markets shows the signs of change in the favor of, for example, HDFC Bank. And, it's like till some time back, SBI was the one which was, favorite stock of the markets. But then market can suddenly again, change back to the older, I would say, bull run. There's a change only for a short period of time. And in this scenario, some of these, I would say, long short funds I have seen, they actually underperform. How would you avoid falling trap to that kind of scenario? Because ultimately your numbers, your formula that you're following up also kind of, will at some point of time give you wrong signals. And at that point of time, your positioning, which is like setting the expectation of client that yes, on risk factor, your product is actually, so going to be definitely robust. On returns, it is a matter of time. Over longer term, it will give. But in short term, in near term, if your model, how much robust is your model? Because in this journey, if investor is not putting money in equity long only, and if he's giving money to you, he is surely having this expectation that the risk is going to be taken care very well. Because he's giving you long-term horizon, and he will see returns over longer term. But in near term, like in 3 months, 6 months, 1 year period, he wants to be sure on the risk part. So, if you could spend some more time on giving, I would say, more conviction on how confident you are in terms of, maintaining the downside risk. That's why I was asking about the beta. of the portfolio?
Yeah, so the beta of the portfolio is around, we manage it around 0.45, 0.5%, zero point 0.5. Okay, so, the objective, as I said, when you say that, short term, there are, based on election, what we see, given that, the government did not get a very good, output on the vote side. So that led to some, impact on the capex side, right? And people moving more toward consumption. But you have to look at things much more fundamentally and get to a decision which sectors you want to be positive on, which sectors you want to be negative on. Like, you said HDFC Bank, or banking, private banks have underperformed significantly, right? So you have to be, and there are less risk on the book, on the large private banks, right? So that helps us, in taking a long term view, given that they have underperformed, as well as the risk is lower on the book side as well as on the valuation side. So it helps us in building that position and waiting for it to work out. uh, Whereas this short term movement, like for example the election thing, was that capex went down, consumption went up, that government will have to focus much more on welfareism and all. So that part, you have to see what is happening on the ground, right? Everybody thought consumption will happen and all, but we don't see that in the results. If you see the data of FMCG, they went up, they came down, right? So you have to see whether it is leading to pick up in demand, or the welfareism which they have done, where is it spent, right? We expected that FMCG will do well, and all the consumer related B2C quality which has not done well will do well, right? But we are not seeing that. So you have to take a much longer term, medium to long term call, and based on that you have to build the portfolio, right? There can be 1 month, 2 month, 3 month underperformance which can come, but if you look at every short term everything, I think you will mess up on the long term then. So that will be a problem, because you can't, because if you are, when you talk about short term, you have to be very reactive, right, rather than active. So if you are reactive, then it becomes a big problem in terms of managing the portfolio, rather than being fundamental, having a mid to long term view, and do your channel checks and everything to understand whether the thesis which you have in constructing the portfolio is right or wrong, right? What we do on the overall conservative, as I said, we are operating how to manage the downside risk, that is on the overall fund level. How we construct the portfolio is based on fundamentals and the valuation levels, how the sector has performed and everything. And then the overall portfolio level, we take a call how much net long we want to take to minimize the downside risk. So that is how we manage the fund, rather than going for any short term movements in few stocks or something.
No, sure. So over longer term, obviously your valuation matrix uh, will uh, will be the one which will ultimately play out, because as we know, prices are slave to earnings. So
Yes.
absolutely, that is right. But I was talking about near term and short term, because in near term emotions may play. It may happen that on stocks and sectors on which you are short, they actually go up, and on stocks and sectors on which you are long, they come down. Because in
So
near
that
term,
will
it's
happen. See, that will happen. See, that is a part of the book, right? You have to play long shot. So it's not a pure long shot, right? You are playing hybrid. So there is a cash portfolio which is also there. Then there is a long short portfolio which is also there, and you do hedging also. So the long short part is there, but generally the calls which I take on the the long short side, it is more from not short term. As you said, it may not work, right? I may be short on some sector, on some stocks, but due to the flows in the market which we have seen, right, it may not work out, right? So generally those calls are taken for a year to wait for whether the earnings expectations which are built in the stock, that gets downgraded, for example in a case of a short case. So the objective is to take a call whether the earnings which is built in the numbers will be downgraded or not, or the earnings which is built in the numbers will be upgraded or not. So that is how the movements in the stocks happen, right? If you see during the result season, everybody waits for how the earnings are. If the earnings is lower, or the management commentary is poor, the earnings will be downgraded. So you have to take a call whether the earnings will be downgraded or upgraded, right? In the medium term, it may not work because you have to wait for the actual results to come and then play it. But you can't expect that I'm taking a short position today and it should work out in a 1 month. That won't happen. So you have to keep on roll it forward and keep your position till the thesis is right. If the thesis is wrong, you have to obviously cut your positions in those cases.
Sure, Suraj, I think well put. So it has been really, I would say, insightful discussing about the fund. Now, in the last, I would say 10-15 minutes, I want to know more about your model's view at the moment on certain sectors, because we want to understand, and if clients or investors who are locked in, are they able to relate to the current view? If you could throw some light on what sectors your model is like bullish upon, what are your fundamental long term, I would say, bets. Like you gave example of you now may be getting long on some of the private banks where you have more comfort on relative valuations, right? So likewise, what are those long term, I would say, fundamental bets
Yeah.
on your portfolio?
Yeah, so the fundamental bets currently are that we are long on private banks, long on insurance, given that they have taken a beating post some regulations which is coming up. That we are overweight. Then some of the capex names which I continue to be positive, and I continue to be negative on the consumption part, the FMCG and all. I continue to be a negative. Cement part also, I turned positive after the disastrous, H1. Given that the expectation is that there will be some improvement in terms of government capex going forward. So we are overweight there in terms of cement and building materials.
Sure. And certain any sectors where you are short?
Short will be majorly, the FMCG sector, where I continue to be underweight and negative. Chemical sector, given the supply glut which is there, and I continue to be negative given the earnings cuts which will continue to come. And I think, and some of the I think utilities, I am on the negative side.
Sure. Just as a disclaimer for everyone who is watching us, whatever we are discussing on the market view or sector view is all for our understanding about this product, because investors need to take well informed decision. If anybody who is not on, I would say, pertinent investor for the product and is trying to take this as an advice, it is absolutely not intended. It is not to be construed as advice. It is just for this particular product that we are doing this discussion. Moving on to the last part, which is actually one thing which is, I would say, limitation. Having said that, though this fund seems to be very attractive, rightly positioned for the current markets, and as I said, this entire segment is absolutely looking for any interesting good product which is able to fulfill the claims. And I really look forward to seeing the performance of this fund over time. And this is like really, I would say, instilling confidence and raising interest. But as I said, the one limitation in such funds is taxation, which actually reduces the returns in the hands of investors. So how does taxation work in this fund? If you could maybe throw some light on that aspect as well.
Yeah, see, the thing is that the cash part of the portfolio which is there, that has a long-term capital gains. So we hold it for 1 year, right? Minimum. That has a long-term capital gains tax, and the derivatives part which is there, which is used for hedging as well as generating additional return, as well as doing that index derivatives, that has a business income tax, right, which is around 39%. So on a net level, the taxation is roughly 25%. Obviously, the taxation is a limiting factor which is there currently. But the product also gives us a much higher flexibility and exposure to generate that additional return and deliver the a higher return than the index due to the derivatives part. The taxation is obviously on the higher side.
No, sure, understood. And what are the other, I would say, things that investors need to be aware or should be informed about? Obviously, fee structure is one. You may want to share what is the fee structure, but apart from fee structure or taxation that we have discussed, any disclaimers that you want to give about the product in terms of what investors should expect in terms of time horizon, liquidity, or other factors that you think are like relevant to be
Yeah,
discussed?
so see, what we do currently, the cash part of the portfolio, given that, as I explained, we have to hold it for more than 1 year, right? Because of the long-term capital gains. So that what we do from a risk management perspective is we invest mostly in FNO stocks, right? In on the cash side also, because it helps us to hedge the portfolio using derivatives. Otherwise, if the stock does very well and I'm not able to sell, that increases the risk of the portfolio. As I said, the objective of the portfolio of the fund is to reduce the risk. So the FNO part is majorly followed on the cash only part. And it's not that we won't go into the mid cap and the small cap side. It is just the valuations are a bit on the higher side, and if you buy more mid caps and small caps, you won't be able to hedge it, and if you sell within 1 year, it will indirectly increase the taxation, which you don't want, right? So if there is a good correction on the mid cap and small cap side, then you will get ideas where you can hold those stocks for at least more than 1 year. You can have a long term horizon on those stocks if you get a very good valuation level to buy. So currently we are looking majorly at FNO stocks on the cash part. That is what I would like to highlight. So basically the fund is more large cap and very less mid cap. We don't have significant any small cap.
Sure. So, would you also like to throw some light on the track record or numbers till date? Like you mentioned, in October, market fell around 6-7%. Your beta was much low, so you fell only, I think, 20%. But if you want to put these in numbers for whatever months the funds has been operating.
Yeah, so for the last 1 year, I think we have beaten Nifty by around, I think, 6%, despite operating at a much lower net long level. The average net long level over the last 1 year would be around around 40%, right? And we have been able to generate a higher return than Nifty, almost by 5 to 6%, with a much lower standard deviation, and having a Sharpe ratio of almost double of that of the market. So that that is the kind of output which we have got over the last 2 years.
Sure, Suraj. I think it has been really, pleasure conversing with you. I don't think there is anything else to be discussed. We have answered all the questions. To everyone who has joined us for this webinar today, thank you so much for joining our Friday webinars. If you have more questions or interest in this fund, you can come to our platform, PMS AIF World. We are doing really very sincere and very, I would say, well-informed work for our investors, for ecosystem, to help them make very well-informed investments. And some of our clients who have given out testimonies about us, you can come and see all those testimonies, and that will maybe enhance your trust, and that will maybe urge you to talk to us. The more you talk to us, the more your portfolios will be aligned to the best funds, because if you invest in the best, your obviously wealth creation experience becomes the best. Thank you so much once again to everyone who joined us for this webinar.
Thank you. Thanks, Kamal.